Good evening, ladies and gentlemen. We welcome you back to our regular macroeconomic overview with Andreas Bickel, head of investment CIO at Zurich-based investment company Blackfort Capital. Andreas has over 25 years of experience in portfolio management as head of portfolio at Goldman Sachs, Switzerland, then Rothschild Bank, Switzerland, and we have heard Andreas's profound microeconomic summaries ever since mid of last year. We've lived through all these changes together, and the last time we saw each other was end of December, when Andreas pointed out that the markets, the year ended with markets growth and more growth was expected. And today, as the markets keep going up, we have to think increasingly of the imminent moment of correction that, and we will discuss that today. I will only want to remind our viewers that this is a member event by CFA Association Russia. The recording will be available to members of the association. And please pay attention to the chat sign on the top right corner of your screens. Please post your questions in the chat, and we will ask those questions to Andreas. So again, good evening, Andreas, and the floor is yours.
Good evening. Thanks for the introduction. Good evening to everybody in Russia and wherever you are following us. Let me share with you my screen. Okay, today's presentation, I gave it the title, "As Long as the Music Plays, We Dance." And this was obviously deliberately done. It is nice to see that the last 3 months were delivering us substantial increase of wealth, very great performance, at least in corporate bonds and in equities. But obviously, what's next? That's the question. One hand, we see a better growth outlook. I will highlight that. We see most likely a much larger fiscal stimulus package than we anticipated before Christmas, where one was already announced, roughly 4 to 5% of US GDP. There is another one in the pipeline, probably more in the terms of 9% of US GDP. This has already had impact, besides on the growth outlook, on inflation expectation and on government bond yields. We will have a look on earnings yields, so we compare equities to bonds, given that probably both assets are expensive. And during the presentation, I will several times highlight what we think is interesting to invest given the actual starting point. So what has happened? Here you see on one hand the money balance sheet printing process of the G4 central banks, and with it the MSCI World all countries. And both figures have reached all-time highs. The question obviously is, where are we going from here? The one thing which is in the cards is that the central banks will print more money. Therefore, it is probably likely to assume that the blue line, which is the MSCI World, will as well go further up. However, given the spike we have seen, correction or a pullback can happen anytime soon, and we will address that down the road. The good news at the moment is, different to December, we have now a debate between bulls and bears. Roughly 50% are bearish and cautious due to the tremendous run, and obviously the other 50% are rather euphoric, which is not a very positive sign. But the good news is, at least not everybody is in the same camp anymore. Before we come to markets, let's let's see what happened. I mean, last year, as we all know, COVID, huge drop in GDP, but, and now it comes the huge but, China's GDP year over year, based on Q4 figures, has grown more than 6%, has reached, the aggregated GDP has reached a level higher than pre-COVID crisis, which came for a lot of market participants as a surprise. I was only partially surprised because I always stressed that Asian and China in particular will come out stronger and faster out of this pandemic situation. I was assuming that in Q1, maybe Q2, the latest this year, we will reach the pre-crisis level. However, we have reached it in Q4, and the main reason for that is twofold. First, the inner Asian trade, including Japan, has significantly picked up. The whole Asian economy, if I can put that in one basket for a moment, has had a very strong recovery. And China has overcompensated the loss of export volume to the US with exports to Europe, which we have seen in the last presentation. You see that here, the Chinese export continues to boom and the trade surplus is expanding at a rapid pace. Although the latest figure, to be crystal clear, the latest figure was slightly weaker, but the moving averages are still pointing towards a significant increase. This latest soft pact is as well supported by the PMIs across the globe, but all PMIs stayed in the growth area. That's extremely important. The PMI of Germany stayed even in the acceleration area, so did the ISM new orders for the US. So it is fair to assume that the beginning of the year was slightly weaker than the ending of last year, but still all major economies are growing, including Europe, although Europe obviously on a lower scale and much slower than the rest of the world. Why? Well, the reason is simple. We all hope for more fiscal stimulus, for monetary stimulus, and this is on one hand priced in, but on the other hand, everything which is not affected by COVID, so basically industry, production, so not leisure, not hotels, not restaurants, they kept producing. And in Q3, Q4, and most likely now in Q1, we see an acceleration of trade and with it of production. And here you see in orange in the US, over the last 2 years, total expected stimulus, so last year and this year, was around 16%. This, however, excludes the fiscal package, which is in the last stage to be approved in the US Parliament. And that one would add another 5 to 9% of stimulus of the US GDP. Given this outlook, Goldman Sachs, that's the red line, has for the second time this year increased its GDP forecast to now 6.8%, 6.8% for 2021. Even the IMF, always behind the curve, but even the IMF sees now around 5%. Large banks see more than 5.5%, and the consensus is somewhere around that. I really don't know what's the outcome, but one thing I know, that's the delta, and the delta is positive. The slope, if you will, is upward sloping, and that pushes EPS up and pushes equities up. My personal guess is we probably get somewhere around 6%. If it's as high as Goldman Sachs expects, I don't know, but the history, at least, of Goldman is they are quite close to the US government and they are quite accurate in forecasting US GDP. So the risk of error if you follow their forecast, is lower than if you follow other forecasts of economists, of institutes globally. Why I support this view? You see here the two yield spreads of the 10-year Treasury yield and the 3-month and 2-year. And you see that we have steepened further. We have steepened more than 30 bips since we have last had this seminar. And such a steepening of the curve basically implies that the recession is over. Q4 was positive, Q1 is expected to be positive. So technically speaking, there was no recession in the US. There was a sharp drop in Q2. But the future, at least given from the bond markets, looks brighter. I must add that today, as we speak, the Treasury yield is roughly 8 bips higher than when this chart was drawn yesterday. So the steepening has continued as we speak. Dr. Copper, last time I remember, I said and I hoped that we might see a pullback, a little correction. Well, if I look at the chart, I can argue that we have seen a pullback to the 50-day average like we have seen in most equity indices, but we have definitely not seen a correction. By the contrary, we see a new high since the global financial crisis. If you follow research today, the basic news is that 10,000 is in the card. Well, if copper were to go to 10,000, you have to reverse engineer what would that mean for equities, EPS. This is a tremendous possible growth ahead of us. So also from that angle, if copper has still any prediction power, even from that angle, this growth support is supported and this outlook of Goldman Sachs looks more reasonable than at the first glance. Meanwhile, central banks in the front line, the Fed, but also the ECB, and you see here some others, they have announced and confirmed that the outlook for the rates stays muted for even longer than when we have last met. So the earliest rise is during 2024. There is a, however, Mr. Powell said that he doesn't expect inflation, that there is no problem, and even if there will be more inflation, they will let it overshoot for quite a while. He didn't specify what that means, but given that the undershooting took decades, I would at least assume that around 2 years, 24 months or more is a reasonable assumption. But will we reach that? That's really, really open. If we look at the consensus forecast and what Goldman Sachs makes out of it, basically they are telling us over the coming 3 years into 2024, there will be no significant overshooting of inflation in the major economies. So not in the euro area or Japan, but also not in the US and in UK. But at the same time, the question is, what do you do with your money? If at the cash level you get 0 before inflation, shall you invest in investment grade dollar bonds as an example? And the answer for dollar bonds is straightforward. After adjusting for inflation, you lose money. The real yield is negative, around 0.5. Even worse, if you were to invest in the CCC bonds, you had a tremendous rally, but with spread levels of around 600 basis points, this is the lowest level since the global financial crisis. So you cannot make really a case for this particular asset class in the sub-chunk area. And all the others, so double Bs and single Bs, had a similar run. The spreads are similarly compressed, but the risk is slightly lower and the outlook for default has in January improved. Therefore, we continue to play it midways. So we stick to our idea that BB bonds on average are a place where you get some returns for an acceptable risk. We prefer still Asian and emerging market debt, selectively in Mexico, selectively in Brazil, and obviously also in the US. The market is so big you cannot ignore it, but the best deal you get in Asia. There is growth, there is less default, and therefore in a hard currency bond portfolio, we would over allocate to the Asian area. If you look at the landscape in the green, and it's the right-hand scale, you see the option adjusted spread for investment grade corporates. It is roughly stable, but it's at extremely low levels of 32 bips. Similar must be said of US high yields or global high yields. They have slightly more compressed over the last 4 or 5 weeks, but you still get more than 300 bips in most areas. It is low, there's no question about it, but if you were to invest in government bonds, you would today have losses. You also see that Chinese versus US credit spreads in the light of the Reddit or the GameStop troubles. Basically, if there is any impact, then it's rather positive. So spreads have slightly tightened. Chinese corporate bonds has outperformed the US, but both actually have not seen yield rising and or spread widening. So for the time being, in both asset classes, you were better off compared to government bonds. You see that here, total negative yielding bonds before today, because today we have seen more rise in yields. After the peak of 18.4 trillion, we are down around 3 trillions to 15.8, and probably as we speak, we are slightly lower. The good news is if you deploy new money, you get some yields, or at least less negative yields than compared to 2-3 months ago. But that's only half the story. The negative part is all institutional investors, be it pension funds, be it insurance, they are by definition invested into these bonds, and they have lost value on that bucket of their portfolios. So we do not like government bonds and continue not to like it. If you were to buy it, obviously we would prefer dollar ones, because you get now for the 10-year roughly 1.27% before inflation. After inflation, depends a bit which CPI, PPI figure you are watching, but after inflation you are slightly negative. And all across major other currencies, the starting point is below zero, still below zero. What I found amazing is this orange line here. This is the allocation into government bonds. And although we have just seen that yields were rising / you lost money, the allocation has risen constantly since May. You also see that there is still a lot of cash on the sideline. That's the line above in the lighter blue, but not in the lightest. Different to our last meeting where the equity inflow over 3 years was basically flat. We have now seen a tremendous inflow, mainly in emerging market equities. Therefore, it's the first time since a very, very long time that we can say there is a certain shift towards equity, but it doesn't come from government bonds. And you also see in the mid blue line corporate bonds, also it doesn't come from that angle, because both asset classes had inflow. You can also see it here. Bank of America did, let's call it a study, a flow of funds study. ultra high net worth individuals in the States have now the highest equity allocation in history on which we have a record on, which is amazing. And now the question is this smart, or are these people just damn? The answer is probably it is not a stupid thing to do. What you see here is steepening of the US yield curve and the return of the MSCI World, the Euro Stoxx 600 and the S&P 500. And in all three cases, you see that the return over the coming months was roughly around 6%. And even more astonishing is the hit ratio of 92%. So another conclusion, which shouldn't really come as a surprise, the FOMO argument, fear of missing out, or there is no alternative, the TINO argument, is supported at least by quantitative historical performance data. Therefore, we continue to like equities, but we would like to highlight that what was said in December holds even more true now. We are at frothy areas, and pullback can happen anytime. But I would like to repeat, pullback corrections, it can happen anytime at the moment, and nobody knows the future, but still at the moment we would not expect a crash defined as more than a loss of 20%. However, why are we cautious? This is the famous Buffett indicator. Basically, it puts the total market value of US equities in comparison of the nation's GDP. We see that we are at 224%, which is a record level, which is higher than in 1991 when we have seen the burst of the tech bubble. As a fact, we have definitely to see that, we have to accept that, but this is not a timing indicator. So this, what I call folly, or if you will, madness of the crowd, can still continue, as we will see down the road. But definitely it is, from that angle, expensive. However, if the 6.8% would come this year, the indicator might slightly stabilize or even go slightly down from current levels, but with more than 2 standard deviation over its own mean, even if we were to see 10% US GDP growth, the overvaluation based on this indicator would not go away. This is brand new. Sorry for the way it looks. It comes from a video blog. This is from Citigroup. They had 2 key statements today. The first one is the blue line. This is their risk model. It is definitely no euphoria. And if you see the bars, the forward-looking return of the S&P once you have reached such highs is definitely low or even negative. But within the same research paper, they also say, however, the earnings expectation have significantly risen. They claim 80% of all S&P 500 companies will deliver this year much higher earnings than there are actually in the cards or what analysts have estimated. We can see that as well in the actual earnings season. The earnings season once more was more than 80% of all companies which have beaten their estimates, and most of them have risen their forecast. But once the figures were out, most companies were losing value or trading sideways, because most of it is probably anticipated and priced in. So also from that angle, down the road, it must be expected a counter move. But also this indicator, like the Buffett indicator, it can stay a while in euphoria before it corrects. This chart makes exactly this point. Since the year 2000, basically every year there was once a pullback of around 10% in global equities and of around 60% in a 50-50 multi-asset portfolio. And as we cannot see the future, I would definitely assume that something like this must happen this year. We have seen in the last week of January a 5-day pullback of roughly 5% to the 50-day average, only to be followed by 6 days in a row, a strike of going higher prices and to reach all-time high after 11 trading days. So a next pullback is quite likely. When it will happen is the key question. My guess is it will happen in late spring, early summer, or even late summer. But given where we stand now, given the euphoria among retail investors, given the money flow, unless there is a shock, probably it is not going to happen until Q2 starts or in the middle of Q2. But honestly, nobody can foresee that. Another warning sign, this is also a figure from today, cash levels of professional fund managers is for the second row in a row below 4%. It stands now at 3.8%. Last time when we have spoken, it was around 4. In January, it was 3.9. So the cash level indicator, which normally is a good counter indicator for a correction, is also flashing warning signs. Last warning I would like to show is the short interest on S&P 500 companies. It is astonishing the level we have reached, and it continues to fall. So there are no bears around, although the debate between bulls and bears have started probably this week really sharply. But in terms of positioning until the end of last week, you see that the short interest in the market is extreme low, and GameStop, which obviously is a long story and has a lot of twists, but basically GameStop learned us that even if a company doesn't produce significant earnings, it can happen that you get into the spotlight of Wall Street Bets, which is a subform of Reddit, and you might get hammered being short, although in the meantime, the over excess has to a large extent already been mean reverted, and all those retail investors who joined the bandwagon and bought in rising markets might have now losses on their books. Having said that, why I keep being positive, let's assume that Goldman, which has revised these figures, so for instance, you see here EPS for the S&P for 2021, the latest estimate of them is 181. Before it was 178. If these figures were to happen, and if by the end of the year the S&P is roughly 400 points higher at 4,300, that would mean that on one hand, the implied PE is roughly 23.7, or let's say below 24. But even more important, the earnings yield is 4.2%. And assuming that in 2022, the earnings would rise to 197 and the index would rise another 300 points, which is then less than 10%, which is rather a normal year, you see that the implied PE ratio drops slightly. So it's below 23.5, and the earnings yield stays at current levels or is even slightly higher. And if you compare that to treasury yields at 1.3% rounded, you still get a decent earnings yield, risk premium, so earnings yield minus the yield of treasuries. And if you were to adjust it for inflation, it looks even more compelling. So although both asset classes are expensive, for the time being, the earnings yield and PE speak rather for equity, although they are elevated. PE ratios and stock market prices depend on earnings or EPS growth. You see here the estimated emerging market profit, which basically is back to levels before the crisis. So the aggregated earnings on the MSCI Emerging Market Index have recovered all the expected and the realized losses. Therefore, the PE ratio of the index is still at low levels compared to the developed markets. Even more astonishing, Europe. Europe is lagging. Europe's EPS growth and recovery is slow, like it was after the global financial crisis, but it is much faster than last time. The reason for that is probably twofold. First, this recession was induced by policy, by politics. And second, different to that time, the European Central Bank has pushed its money printing press in a way which like never before, really unprecedented. And this has a certain impact. And at least exporting sectors in Germany, also in Switzerland and in other parts of Europe, they show growth. They don't show growth like in a business cycle, but the drop was not that strong, and the recovery is higher than most economists have in their forecast. You see that also in stock prices. You see that actually globally in most small and mid caps have outperformed larger indices. The most prominent example is the Russell, which we will see at the end. But the same holds true for Asian small caps, which had a strong recovery and are extremely undervalued. And it also goes together with what I've said in the beginning. The trade from Asia to Europe has significantly picked up, at least if measured by the Chinese export statistic. But it holds also true, for instance, for South Korea. South Korea used to be a very good leading indicator for the world. And if you see what their stock market did, assuming that they are not completely mispriced, we can expect more in Europe and much, much more in Asian economies and in the US, and to a lesser extent in Latin. If we aggregate this earnings outlook, this is a statistic I found. Basically, it compares upgrades and downgrades. We are almost at the highest level in this history. They claim that most likely in 1-2 months, the bottom-up estimates and earnings revision will reach a new high, which is also supporting strong EPS growth and higher stock market, and obviously reversed engineer the GDP forecast for most countries is probably not completely out of whack. Risk premiums, we had that before, starting with earnings yield. Now we are one step further and subtract the yield of the bonds. As you can see from this chart, the highest risk premium you get in Asia Pacific ex-Japan. The developed world is on similar levels on this chart. Amazing is as well that Japan, for the first time since 1990, has overpassed 30,000 in the Nikkei. So also Japan has surprised. The latest GDP figure which came out has surprised. The growth there comes from the inner Asian trade. And there we are back to the starting point. Asia is going to be this decade the leading economy with the strongest growth, and probably this century will be Asian-led, and there will be a battle between the two superpowers, so China and Asia, regarding the leadership in technology, maybe even in military area. But don't underestimate that Asia is not just China. All the other countries, be it the former tigers, but be it ASEAN, so all the area is growing at a fast pace, and they are ahead of us in terms of COVID fighting. New Zealand, so Pacific, had 17 cases, and they just closed the whole part of their island, not the whole economy, because of 17 cases, because they have zero tolerance policy. In Europe, the good news is the figures come down like in the US. The bad news is and the unknown, the elephant in the room, is the mutants. So the cases with the mutated virus are rising. It is open if we are able to prevent the third wave, or if we are going to open up too fast. The pressure on governments in all Europe is extremely high, because you see lower figures, and you see everything is closed, lockdowns, and the people have really enough. I sit at home, as you can see. People are really tired of being at home. You cannot go anywhere. Everything is closed, and it is also cold. So if you meet outside, it's really no fun. So the risk that we get a third wave in Europe has risen, given the unwillingness of the population to follow what governments impose. The US, on the other hand, and to a lesser extent, I would also say the UK, they have, in terms of cases and vaccinated people, a very good hit ratio, i.e. they have more people vaccinated than open cases. And in the US, although they didn't manage at all this crisis, the figures are coming down. The same can be said in India, where probably 60% or more of the population were somehow infected. And the hypothesis is that we see there herd immunity, and they also on top of it vaccinate the people. So in these two cases where one let nature just happen, you had tremendous amounts of cases and really a sad situation, but it might well be that down the road, both areas might come faster out. And then you have China, which is already out, and you have the same in Australia, you have the same in New Zealand, to almost the same extent in Japan. And you see latest Japan GDP figure, it manifests in higher growth. Once you reopen, there is a catch-up trade. Therefore, the future is probably going to show surprising data on EPS and on the economic as a whole. This slide I have shown last time. Are the Roaring Twenties back? I don't know, but I made the point that the secular bull market, as I call it for years, is not over yet, and there might be still a doubling from the actual prices. I found this chart. This chart is basically claiming, if we were to see a similar tech run and tech bubble like we have seen at the turn of the century, we have still roughly to double from where we are. And the technology change compared to that time is larger. The impact on the economy is larger. And the valuation is still in a range where we can argue that we are significantly cheaper than that time. So from that angle, I stick to my thesis that this bull market will end in euphoria and with a melt up. And most likely we haven't seen that yet. You can see that also on the Shiller P or on the KP, if you will. So you see different bubbles, how the Shiller P has expanded and how much time it took to contract. And as you can see, the US is in the 30s, the world is around 20, the Nasdaq is even higher, around 60. But compared to previous bubbles, in particular the one, the tech bubble, there is still room to go. And therefore, even from that angle, it is open if and when we see a contraction of the Shiller P. I would guess from higher levels. We have seen so far emerging market equities rallying, which I would argue was anticipated given the weak growth, weak dollar outlook and the expected growth outlook. If the correlation compared to the past is going to hold, we probably will see commodities catching up. So we are back to what I've said in the beginning. copper at 10,000, industrial metals. Probably gold will not participate, at least in the beginning, until we see a pickup. The wild card is for me the soft commodities, agriculture. So let's pull it together. Here you see the S&P 500 chart, the pullback in January within 5 trading days to the 50-day average, and its recovery since then. We are trading today at a new record high again. If you look at this chart, you haven't seen a sell-off with volume. That's in the middle of the chart. But the RSI is back in the overbought area where it can stay for a while. But as said before, pullbacks can happen anytime at such frothy levels. If you have a look back what has happened since December, basically since we have last talked, I mean, excuse for a second, and I might be fooled by randomness, but I can see that MSCI Europe was the weakest area since the beginning of December, followed by the broad US market, but still 10% is quite a decent return. But the winner were, on one hand, Russell 2000, or if you will, global small caps, but they are not shown here, with more than 26% in the Russell. Roughly 20% of all Russell companies are loss-making, but the business cycle is turning. So you have there that zombification, which we have talked in the past, but at the same time, this is the reopening reflation trade. And Asia has significantly outperformed, almost 20%. And then last but not least, probably closer to most of your hearts, given the tremendous rise in the oil, you have seen as well the MSCI Russia outperforming most of all markets. This chart looks scaring. That's the WTI future. You can also take the Brent oil price. We have seen a tremendous run and continue to go up. If the inflation trade continues, the reopening trade continues, and the OPEC plus production cut holds for a while, probably slightly higher prices are still easily in the cards. And if you were to invest, different to the last time we have talked about this at length, the orange line on the top is now in backwardation. So the products you can buy, if you don't buy directly futures, you don't have the roll losses in the product, but you have definitely to assume that prices go further up. However, these statistics, which was put together by this MPAS, I have no idea what's behind it, but I come across it regularly they claim, and I have a sympathy for it, they claim that the backwardation is probably partially at least driven by an expected oversupply of oil down the road. Makes sense for all these green deals we see across the globe. Biden wants to invest significantly amount of money into renewables and green energy. So probably oil might go slightly up, but most of it we have probably seen. On the other hand, when you see risk on, when you see rising treasury yields, gold has a hard time. And now this chart is broken. We trade below the 200-day moving average. I have updated the price just 2 hours ago. You see we are now below 1800. This is the dark blue bar there behind. Next stop is probably 1750. If you have it in the portfolio for a protection down the road physically, I would keep calm, maybe wait if it goes really down to 1750, and you might think of adding. as an insurance policy, in particular if you were to see the expected inflation down the road and maybe corrections in the markets. It is also fair to assume that most mining stocks are still priced in a way that they are not expensive and that they are not having hedged position on gold, so they are not hurt from that angle that they were locking in some profits or limiting their upside. But the gold chart, and if you believe that markets might continue to go up, it looks vulnerable. The easy moves, easy money is probably for the time being over until we see further uncertainties and maybe a risk-off period. The dollar is a funny thing because it happened that until the inauguration of the president, it got weaker. Everybody said that, including myself. And now it comes the funny bit. Since then, it had first a run and now got weaker again. And in hindsight, strategists come up with such a chart and claiming that it's very usual that you see stronger dollar until the inauguration, weaker dollar, and then a slightly period of stronger, and then again a weaker dollar. The funny thing of this statement is obviously why nobody came up with this before it happened, because you could have made easily in December the case, stay away from dollar or expect it to weaken until the new president comes, and then a period of counter move, or if you will, a mean reverting. Down the road, I still believe that the dollar is probably rather weakening, in particular, given what Mr. Biden has announced. This chart basically claims that a rising US yields, so we are talking of treasuries, doesn't necessarily mean a stronger dollar. And as we speak, the dollar has slightly weakened since the last couple of trading days, although treasuries have risen significantly over the last 10 trading days, as an example. With that, I come to the conclusion. They are not completely different to last time. So we have seen a pullback. I think I said the pullback might happen in February. In reality, it has happened in the last week of January and was mean reverted in the first week of February. My guess is that the next pullback will probably come in Q2, that we will see a liquidity-driven rally climbing the wall of worries until spring, early summer. Why I believe that is basically because the growth expectations, the earnings outlook are both not yet priced in and are probably too low for the average investor and forecaster. The assets are supported by central banks intervention, in particular the Fed. Earnings yields speak clearly for equities, although they are expensive, and definitely not for bonds. If you were to invest in bonds, we still believe you have to be somewhere slightly below the investment grade, but we also avoid triple C's and single B's. We dislike and continue to dislike government bonds. Yields are rising, so we would definitely not recommend to invest there. We prefer the Asian area, emerging markets, and the US, and to a lesser extent that holds true also for bonds, not just for equities. Different to last time, we do see that some commodities mostly related to production and industrial see a reflation trade, and copper as an example. The latest rumors and forecasts is that it goes up to 10,000. Gold is continuing in a consolidation before it rises, and it might go even further down, as today we have seen a spike down. Therefore, the warnings, they stay the same. I have shortened them slightly, but I personally have no cheap asset classes on my radar screen. So it's a relative trade, and also cash is definitely a risky asset classes, as I've alluded last time when we had our seminar. With that, I have concluded and I open it up for questions. Thanks a lot for your attention.
Thanks so much, Andreas, for clarifying once again what's happening all over the world in the markets. And you mentioned that the GDP growth of China has risen up back to the levels, to the pre-crisis levels. What about GDP growth of other countries and other regions, and the US in particular? Is it coming back to pre-crisis levels?
The US is an easy one. The US is expected to be back in the latest Q2 to levels of the pre-crisis, so if you aggregate. Europe is probably taking until the H1 next year. Other Asian areas, so Japan is very interesting. They analyze the figure, so it's a bit hard to compare it, because basically what they showed today was something like 12%, but this is 12% analyzed from a quarter figure. Most likely later in the year. For other areas, I'm really sorry, I don't know when the pre-crisis level will be reached, but what we can say on general is that it looks like these countries which regularly produces PMI and are on my radar screen, they are continuing to grow, and we probably will rather see a growth surprise. Having said that, the German government has just recently decreased their GDP forecast. The future will tell how it will be, because it was mainly driven by the sentiment in the public. What they probably overestimate is the impact of their lockdown, because the industry is up and running. And if today came out the latest ZEW index, which normally is cautious and bearish, but it surprised strongly. So even there, where you have cautious forecasts, probably we're going to see surprises to the upside. Obviously, the impact, the shrinking part is in the books and is visible, but more equity markets, bond markets price in the futures, and unless government bond market participants are completely wrong, this rise implicates of the yield that there is much more growth expected from the bond market than what the official forecasts tell us.
Mm-hmm. Let me invite once again our viewers to post your questions on the chat in the top right corner of your screens. We will ask those questions to Andreas. But in the meantime, let's go to our region. We are in the emerging markets, in particular in Russia. There is an opinion that the Russian ruble is undervalued at the moment, and we should be bullish about it. What would you say about Russian currency?
I would agree with the statement in regards to dollars. Definitely. It is undervalued, so the ruble should strengthen further. We have seen that over the last weeks, and then we had a slightly counter move, but as we speak, or at least when I started this presentation, it was roughly at 73, slightly stronger, dollar weaker. I would expect that to continue. And if the thesis of the commodity-driven cycle holds true, this will definitely support as well, in general, emerging market currencies, and in particular, obviously, the ruble.
Mm-hmm. Thank you. You mentioned that the oil is going up and could be still expected to grow a bit further, even until shale oil producers start increasing their production. Do you think there is a certain cap that you would think of for the oil price?
That's a very tricky question, but oil experts expect a cap around $70. If that's going to happen, it has to be seen. but I would definitely say that the rise was extremely fast and extremely brutal, and probably you need a further catalyst. So if you see on these Reddit forums, suddenly everybody buys ETNs on oil, everybody slash this retail investor who follow, that might push short-term markets up, but the future market is telling us something else. The future market is telling us that most likely there will be an oversupply, and the price for oil might stabilize on a slightly lower level than where we are now.
Mm-hmm. Okay, Andre, our viewers are asking, well, a straightforward question: what equity sectors will outperform, in your opinion?
Good question, very good question. So I would say cyclical small caps. I would expect Asian tech to continue to outperform, and I would expect US tech mean reverting. So the Nasdaq has underperformed the Russell, but that probably is going to mean revert. Having said that, probably the Russell continues, small mid caps. I'm not in the value camp, but certain value stocks are also cyclicals. Therefore, if it's cyclical, can well be, then I would definitely have a look at everything which is industrial in a broader sense. And the wild card are financials. Higher yields help definitely both banks and insurance. Banks, on the other hand, at least in Europe, have certain problems with profit margins. So if you were to invest in that area, I would rather go for insurance, higher dividend yield, and they have pricing power. After last year, they will increase the contracts, the prices for contracts. Sorry, and it's not a sector, but maybe we should also re-stress that Asian equities in general, not just Chinese equities, so Indian are very cheap, are definitely worth having a look. And a wild card for me, because I honestly have neglected Japan for the last 20 years, and it was most of the time correct. But Japan has momentum, and that might last.
Well, Andreas, we're coming to the end of the hour now, and thank you very much for this update. We've seen that since your last presentation in December, things have grown up, things have improved, and still we remain cautious on some prices and on the timing when we should expect a correction. So I hope very much that in a month or so we have an update with you and talk about the developments. And again, I want to remind our viewers that this was a member event on the macro developments in the past month, in the beginning of this year. The recording will be available to members of CFA Association Russia, and we look forward to seeing you back next month and beyond. Thank you very much.
Thanks a lot for having me.